Hello everyone, welcome back to Rise Finance. The market so far this year has been very volatile due to uncertainty over the Fed rate hike and also the geopolitical tensions between Russia and Ukraine. This last week, we saw some wild swings in the market. On Monday, March 7th, we saw a drop of almost minus 2.7%, which was the largest fall in S&P 500 in the last 2 years. And on Wednesday, March 8th, there was an absolute reversal. We see an almost 3% spike, which was the largest spike in the last 2 years. And we see this pattern repeat in the last 1 month or even year to date. With so many ups and downs, an investor can never really know where the market bottom is so that they can invest more money at that moment. And that is not possible to predict even by the best of the experts, who can only predict the future based on hindsight. The trait of a good investor is to always stay invested through good and bad times because the stock market generally tends to go upwards in the long duration. Here, the famous quote by Warren Buffett that be greedy when the market is down and be scared when it is up rarely gets followed when one sees a huge downturn. The very basic human psychology guides the investor to sell their investments when they see a dip in the market and keep buying when they see a rise, which is exactly opposite of what should be done. This is where I trust the logic of automated investing and have been using Acorns to help me in this process for over 4 years now. I have covered the Acorns investing process in detail in one of my previous videos. You can check that video out using this link in the card. To briefly describe Acorns, it is a robo-advisor investing app, which means while opening an account in Acorns, it asks for a set of questions, and based on the responses given, it would then suggest one of these portfolios which are handpicked by their experts. The user can then either go ahead with the choice given by the Acorns app or choose a portfolio that suits their investment risk profile. In my case, I have the aggressive portfolio setup, which has 55% in large company stocks, 10% in medium company, 5% in small cap, and the remaining 30% in international. For large company stocks, Acorns chooses the VOO ETF, which is the S&P 500 ETF. For medium company stocks, it is IJH. For small company, it is IJR, and for international, it is with IXUS. The best feature that Acorns provides, in my opinion, is roundups, which invest a spare change from your regular purchases back into your portfolio. So, say you spent $2.50 on a cup of coffee using your credit or debit card. What Acorns then does is it rounds up the purchase to the nearest dollar value, which in this case would be $3, and considers that 50 cents change towards investing back into your portfolio. As and when the spare change total is $5, Acorns would then invest it back into your portfolio on your behalf. In my case, the roundup settings are always turned on, and I also invest $10 every Wednesday. So that's a recurring investment. As you can see here, the recurring investment along with the roundup, and they slowly keep adding up. And in this way, I invest into the market no matter it being up or down. And that consistency has what led my portfolio to grow gradually over time. As I mentioned earlier, I have been using Acorns for the last 4 years, and you can see here the consistency at which the portfolio is gradually growing over time. Here we see a market dip due to the COVID correction in early 2020, and after that also it kept on nicely growing up till the recent volatility. Having Acorns invest on your behalf, irrespective of whether the market is up or down, is what maintains the investing discipline. As I had briefly touched upon earlier, while opening an account in Acorns, these are the portfolios that are suggested. In 2021, Acorns added the sustainable portfolio, which considers the ESG philosophy of investing. ESG stands for environment, social, and governance. The ETFs in the sustainable portfolio consider the ESG factors in filtering out companies that they consider for investing. I wanted to compare the performance of the core portfolio that considers the standard ETFs versus the sustainable portfolio with the ESG based ETFs. For that, I went to my favorite website for comparing the portfolios, which is Portfolio Visualizer. Here, I set the start year as 2010, considering an initial amount of $1,000 and contributing $100 every month and rebalancing monthly. This is because what Acorns does is smart balancing, which is when the money is being invested into your portfolio, what it does is that It checks which components of the portfolio are overweight or underweight and invests the amount into the underweight components. That's the reason why I'm selecting this option as rebalance monthly. That's the closest option that we have to replicate what Acorns does in real time. And I reinvest dividends because that's what the app does. And here I've given the portfolio names as the Acorns Aggressive and Acorns ESG Aggressive. Let's rename this to Core so that we have a proper labeling. And here, what I've done is portfolio one, which is the Acorns Core Aggressive. I've given VOO, IJH, IJR, and IXUS, and given the same proportions as it is in the Acorns app. And in portfolio two, I've given the sustainable ETFs and their respective components. And when we say analyze portfolios, what it's first is a message that says because the ESML ETF that started in 2018, because of that the results are limited only from Jan 2019 onwards. So we have results to look for the last 3 years. And what we see here is a very minimalistic difference of just $8 between core and ESG. Here we see the investments almost tracking close by each other. Let's do one change to the settings. Because ESML is limiting our data set by just 3 years, let's say we make it to 0 and the large and mid cap ETF to 15. And when we say analyze, we now have the results for the last 5 years. What we see here is a slightly higher diff of almost $200 between core and ESG. Still, they're very close by. But what gets my attention is if you go to the assets tab and if you look at the expense ratios, the core portfolio ETFs have a very, very less expense ratio compared to the ESG ETFs. We can see here the Vanguard S&P ETF has an expense of 0.03%, whereas the ESG counterpart has 0.15%. That means the core S&P ETF is already 0.12% ahead right off the gates. These expense ratio differences may look very small at this moment, but over time they matter a lot. If you've liked the video so far, I would appreciate if you would hit that like and subscribe buttons so that YouTube can suggest this video to many like-minded investors like you. So that was the comparison between the aggressive portfolios of core and sustainable. Let's see now how the moderately aggressive portfolio compares between the core and sustainable. The reason I want to see this is the aggressive portfolios are completely tilted towards the stock market ETFs, whereas the moderately aggressive ones have the bond component also. Almost 20% of the moderately aggressive is into bonds. So with that in mind, let's see how moderately aggressive portfolios compare between core and sustainable. We go back to portfolio visualizer and use the same settings that we did for the aggressive portfolios. The start and end year remain the same. The initial amount is $1,000 that is contributed every monthly. The rebalancing is set to every month and reinvest dividends is yes. And the portfolio is Acorns moderately aggressive. Let's rename this to say core. And the other one is ESG. Coming down to the portfolios here in portfolio one is the core moderately aggressive ETFs and their compositions. And portfolio two is the sustainable moderately aggressive portfolio ETFs and their compositions. And then we click on analyze portfolios. We get the same message again saying ESML is limiting our results to this last 3 years. And when you look at the results, here the core portfolio is just $5 ahead of the ESG portfolio. And just like how we did with our aggressive portfolios, let's go back and modify the ETFs so that the ESML is made to 0 and the large and mid cap is set to take its position. And when we click analyze portfolios here, the result set goes back to almost 4 years. And looking at the output, the ESG portfolio does slightly better now than the core portfolio, almost like $150 difference between the two. Again, not much to differentiate. When you go back to the assets tab, here we can see again the same concern that I had with the aggressive one. When you look at the expense ratio, the core portfolio ETFs are very low expense ratios, and for the ESG, they are relatively high. Again, the same thing. The lower the expense ratio, the higher the benefit that the investor gets. So with these portfolio tests, what we can conclude is that there's not much difference between the core and the sustainable ETF performances. both of them giving very identical results. I would personally choose the core portfolio as they have much lesser expense ratios compared to the sustainable one. But if you believe in the ESG investing philosophy, then the sustainable Acorns portfolio with slightly higher expenses gives you a similar result as the core. No matter what portfolio you choose, my advice is keep it simple and invest regularly into the market, and you would see amazing results from the market in the long term. These investments need not be high as in hundreds or thousands of dollars. It can start with as little as $5. And with the roundups feature that Acorns provides, you won't even realize that your day to day transactions are also fueling your investment portfolio on the side. Maintain the investing discipline, and the market will surely reward you in the long run. That is all I have in this video. Hope you liked it. And if you are interested in signing up for Acorns, I have my referral link in the description notes below. If you do use my referral link, you will get a $5 investment bonus from Acorns. So I hope you'll use it and contribute to this channel. Thanks for watching. See you in the next video. And until then, let's try as much as possible to be financially healthy. Bye.